When I sell a covered call, I get to select the strike price, but I lose money if I pick the wrong one. One of the key profitability factors of selling a covered call is the strike price. And that's because when an option contract gets exercised, that strike price helps you figure out the profit or the price appreciation you'll receive when your shares get assigned. Get my free course where I show how I generated income using covered calls. Just visit my website, coveredcallincomegeneration.com. So when selecting the strike price, it helps determine how much profitability you'll make with a call option. I jumped over to my account history and let me show you the transaction where my call option got assigned. So for this transaction, it's for stock symbol BNGO, and it has the $10 strike price. This is a call assignment. So I ended up having my shares taken away or assigned to the buyer, 100 shares. Now this was a profitable transaction for me, but some of you seasoned option traders will immediately recognize what the problem is. But before I discuss what went wrong, let me first give you a little bit of the background of my transactions so that you can understand how I ended up in this position. It started earlier in the year when I actually sold the covered call for symbol BNGO. Now I submitted my order and it was filled on January 22nd at 12:30 p.m. Pacific time. Now at the time that I sold this covered call, it was paying $1.65 per share in premium. So when this option contract was actually purchased by a buyer and the order was filled, I received $165 as a premium deposited into my trading account. So far, so good. Now let's jump forward to February 19th to find out what happened with this covered call option contract on the expiration date. Here's a daily chart for Bionano Genomics. Let's focus in on the expiration date of February 19th. And just as a quick reminder, the strike price for my covered call option contract was $10. So the stock price closed at $13.57 a share, which is way above my strike price. So this option finished in the money, and the option contract got exercised and my shares were assigned to the buyer. I created a simple worksheet so that you can see all the numbers involved with this transaction. I'm now going to take a moment and walk you through them. So I held 100 shares of Bionano Genomics, stock symbol BNGO, in my portfolio. The cost basis for my shares was $9.30. So I ended up selling a covered call on January 22nd, and I used an expiration date of February 19th, making the length of this option contract 28 days. At the time when I looked at the chart and I considered my cost basis, picking a strike price of $10 seemed fairly reasonable. And at that time, it was paying $1.65 per share. So when the option contract got filled, I received $165 as premium. But then as you saw, on the expiration date, the shares closed at $13.57 per share. So I ended up losing my shares because they were assigned to the buyer. And in return, I received $1,000 as payment for those shares. And that's because I accepted the $10 strike price. So the $10 times the 100 shares is the $1,000. And I did end up keeping my premium, so I got to keep the $165 in premium. However, recall that the stock closed at $13.57 per share. So if I could have timed it perfectly and sold my shares at the closing price, I would have received $1,357. Now that's a difference of $357 of profit potential that I missed out on, because the market price closed so much higher than my strike price. Now overall, this was a profitable trade for me, but I sure would have liked to have received that extra $357. Let me share this next example with you. I sold this covered call for Marathon Digital Holdings, stock symbol MARA, on March 9th, and it was filled that morning at 10:32 a.m. Pacific time. Now this covered call option contract had a strike price of $40 and an expiration date of March 12th. Now at the time, it was paying $1.20 per share in premium. So when the buyer purchased this option contract and the order was filled, I received $120 deposited into my trading account. Now that you've seen the covered call option that I sold, let's find out what happened on the expiration date. Here's a daily chart for stock symbol MARA. Let's focus in on the expiration date of March 12th. And just as a quick reminder, the strike price for the covered call that I sold was $40. And from the chart, we can see that on the expiration date, the stock closed at $40.70 per share, which is above my strike price, meaning this contract finished in the money, and so my shares were assigned to the buyer. Here's the assignment transaction record from my account history. It's for stock symbol MARA with a strike price of $40, and this covered call was assigned. As a part of this transaction, it included 100 shares. I was paid the $4,000 for my shares, and that's the $40 strike price times 100 shares, and the closing price of Mara on the expiration date was $40.70. I added this transaction to the worksheet so that we could walk through it and do a quick review. So this is the second covered call example using symbol MARA. Now my cost basis for this stock was $22.56 per share. I ended up selling the covered call option contract on March 9th, and I specified an expiration date of March 12th, so this is a really short duration option contract of only 3 days. I had selected the $40 strike price, which at the time was paying $1.20 per share in premium. So when the buyer purchased this option contract and the order was filled, I received $120 as a credit deposited into my trading account. Now, as we saw, the share price closed above my strike price. It closed at $40.70, so the option contract finished in the money. And as a result, this option contract was exercised, which means my shares were assigned to the buyer, and I got paid $4,000 for my shares. Additionally, I was allowed to keep the premium that I had received of $120. So in this example, I missed out on $70 of profit if I had been able to directly sell my shares on the expiration date and received a full $40.70 per share. I've got one last example as it relates to strike price within a covered call. This is the transaction record for my account history where I sold a covered call for AT&T stock symbol T with $31 strike price and an expiration date of April 30th, 2021. So I submitted the order on March 19th, and it was filled that morning at 6:36 a.m. Pacific time. And at the time, it was paying 43 cents per share in premium. So when the buyer purchased this option contract and my order was filled, I received $43 as a premium credited immediately into my trading account. Here's a daily chart for AT&T. I'm going to focus on the expiration date of April 30th of 2021. And just as a reminder, the strike price for my covered call was $31. Now, as you can see, AT&T on that day closed at $31.41, which is above my strike price. So this option finished in the money. Here's a copy of the transaction from my account history where we can see where the shares of T were assigned. This transaction is for company AT&T. Now, I sold the covered call with the $31 strike price and an expiration date of April 30th, 2021. And you can see that my shares got assigned. 100 shares of T were assigned to the buyer. I received $3,100 in payment, and at the time of the expiration, the shares of T were worth $31.41. So I added the third covered call transaction to this worksheet. Let me walk you through it. My cost basis for my shares of AT&T was $29.01. I sold this covered call option contract on March 19th, and I specified the expiration date as April 30th. So this option contract had a duration of 42 days. I had selected the $31 strike price, which at the time was paying 43 cents per share in premium. So when the buyer purchased this option contract and my order was filled, I received a $43 premium as a credit deposited immediately into my trading account. Now, because the closing price of $31.41 was above my strike price, this option contract finished in the money and the option was exercised by the buyer. And so, as a result, my shares were assigned to the buyer, and I received $3,100 in payment for those shares. Additionally, I was able to keep the premium that I received of $43. Now, all three examples were profitable option trades for me. I profited from the stock price appreciation as well as the gains I received from the premium payments that I had received. However, I missed out on the price appreciation that occurs for anything above the strike price. Recall that in the first example, the price closed $3.57 above my strike price. So even though the market price was $13.57 per share, I had agreed to sell my shares at $10, the strike price, as stated in the terms of the option contract. Now keep in mind, when I saw the share price increasing, I could have purchased my option back, which is known as a buy to close, and removed my obligation to sell the shares, but I was ready to sell them and move on to other trades. Be sure to get my free one-button stock screener. It's the tool I use to help me pick stocks for option trades. You can download it at my website, simpleoptiontrading.com/one-button stock screener. If you like the information about my stock picks, then consider joining my Patreon, where I share exclusive videos of my stock picks every week that I'm going to be using for profitable trades. I also include my research notes, stock analysis, and trading strategies for every stock I pick to watch for that week. And of course, all my videos posted on my Patreon are ad-free. There's one last thing before I end this video. Now, making profits and generating an income from option trading is a great thing, but keep in mind that all gains made from trading are considered income and are subject to applicable tax considerations. So every month, I save a portion of the profits that I earned in order to pay for my federal and state taxes. So please consult with your CPA, licensed financial advisor, and/or tax preparer regarding the tax liabilities for your unique situation. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.